For those that know me, you notice that I'm casual Kevin, just so you know, no longer suits and ties, but still the great information. Today, you know, when Sharon asked me to do this, and thank you for having me, Sharon, I thought about how do I talk about this in a way, how can you make it fun, because mortgages are not fun, but the reality is, I decided to come up with this title called Is Greater Than Was. And the reality is that many people don't know rates are holding some buyers back. In fact, a recent study said that why buyers paused or stopped their home search over the last 6 months, 72% said it was because of mortgage rates. And right now, if you're a buyer, working with a buyer, you got to recognize the elephant in the room is we are selling a product they don't want because of the rate. But is that true? Are we forgetting that we don't just sell brick and mortar? We sell an experience, we sell emotion. The thing of it is we are selling products people don't know why they must buy now. Have you ever had a buyer that has been fully qualified, ready to go, and didn't buy? Anyone? Mm-hmm. It's not because they can't, is they don't know they should, and they don't know that they ultimately must. It's our obligation, duty, and responsibility to communicate that to them, because a disproportionate amount of consumers believe that right now is a bad time to buy a home. Conversely, it's the best time in the world to buy a home. And our job is not just to have commission breath anymore. Our job is to become advisors, consultants, and share the opportunity. And as we talk about the opportunity, I want to take a couple hot moments to talk about mortgage rates. The first thing is this. They're very volatile today, aren't they? But the reality is what you need to know, need to communicate to your seller, and this might be old news for many. Where do mortgage rates live? Does it live in the stock market?
No.
The answer is no. Do mortgage rates live based on what the Federal Reserve does? The answer is no. Now, the Fed kind of sets the tempo for how everybody's going to start to dance, but they don't define what the dance is. Mortgage rates live in the bond market. Now, bond markets work as counterintuitive, because when a bond price goes down, in order to attract more buyers, yield goes up. When yield goes up, mortgage rates go up. And conversely, when bond prices go up, yield goes down because they're getting a higher price. They don't need to offer so much yield. That causes mortgage rates to go down. This is a snapshot of the bond market over the last 12 months. Notice here, we were the highest in 2023, was around October. We're on mid-sevens. We're not as bad as we were, but if you look at here from 2024 on, right now, mortgage rates are the highest rate that they have been in 2024. Oh no! But I want to talk technicals, because mortgage rates move because of two reasons. The number one reason they move is because of technicals. Now, I'm not asking you to get into the weeds, but I'm asking you to be proactive if you're talking to a client that read an article that said that the Fed is going to do nothing, or the Fed is going to go up, or the Fed is going to go down. Understand it is unrelated to the fact of where home prices are going. Let me say it one more time. Hey Sharon, I just put a brand new tires on a car that I'm going to trade in. Do you think it added any more value to the car?
Not much.
Nothing. I just put a brand new hot water heater in. Do you think it adds any more value to the house that you're selling? The answer is no. What the Fed does is just like that brand new hot water heater. So the reality is rates move because of technical factors. So you can see this line here, support. You can see this line, resistance. Mortgage rates, from a technical point of view, always want to trade within this channel. This acts as the roof. This acts as the floor. So when the floor breaks, guess what happens? It goes all the way down to China. There's nothing to stop it. When we go through the roof, there's another holding called a resistance 2, and that's like the roof of the house. So it stops there. So the reality, those are technical factors. The second reason why mortgage rates actually move is because of economic news. This is should be on my Facebook or my Instagram today. So right now they move because of economic news. So Jerome Powell, the meeting will start on Tuesday. We'll see what he's going to say. If you think rates are going to come down, you're wrong. The reality is rates will most likely get higher faster. But the only thing that will move faster than higher rates is home prices. Rates will fall down, and when they do, guess what's going to happen? Home prices are going to have a quantum leap, a 10x jump. We're not going to be like the pandemic, but we are going to be pandemic-like. Does that make sense? So the real opportunity is actually higher rates. We'll have this Mac Daddy here jobs at a very high level to bore everybody for 13 seconds. People work in the economy, they have a paycheck. You have a paycheck, you can buy things. You can buy things, you got inflation. So the reality is let's talk about the next elephant in the room. But mortgage rates are the highest they've ever been. First off, lead with a little bit of empathy. A lot of generation millennials lived through the great 2008 mortgage renaissance, I like to call it. They saw their family go through short sales. They had to move and things of that nature. Be empathetic to it. But remember, mortgage rates are not the highest that they've ever been. Actually, higher mortgage rates represent an opportunity. I want to ask everybody to do this. Let's say this. Higher mortgage rates equal opportunity. Because lower rates means higher home prices. This is your modus operandi whenever you see anybody or anything any time of the day. Let's say it one more time. Higher rates equal opportunity. And it's your obligation, your duty, your responsibility to talk to your suspects, your prospects, your leads, and your clients to make sure that they understand this. Because you see, right now, we are in an information crisis about housing. We're not in a housing crisis, we're in an information crisis about housing. And the problem is, you have part-time agents not fully dedicated to the business that make their decision based on a post they see on social media on what the market is. And they're salesmen, they're order takers, they're not true consultants. Renee, let me ask you this question. How many hours of CE did you do last year?
12.
Okay, how many hours of masterminds, how many hours of training to become sharper in your business are you? Did you do? Do you think? Yes.
400 hours plus.
Right. You got no ability to compete unless you're dedicated to your business like she is. The reality is Sharon might not be on a webinar live, but at 2 in the morning, she's watching the replay. Fair statement? Mm-hmm. So the reality is being a student of this market is the difference between making minimum wage at what you do and being filthy wealthy, helping families create generational wealth. But our job and obligation is to communicate what the opportunity is. Now, the one thing I want to talk about is something that every one of you miss. Renee, I'm going to pick on you because you're sitting in the corner. Renee, you got a 7% interest rate. Congratulations. But does Renee really have a 7% interest rate? Are you communicating that to the seller that a 7% interest rate is really not what your interest rate is? Your note rate is not really what your interest rate is. Here's the reality. You have to know 3 things to determine the after-tax benefit of buying a home and the mortgage. What your marginal tax rate, what your mortgage rate is, and what's your after-tax interest rate. Understand interest that is paid, SALT, state and local taxes, are tax deductible if somebody itemizes. Now, granted, not every one of your clients will itemize. But again, the reality is it's our obligation, duty, and responsibility to give the flip side. So here's the thing, if somebody's in a 24% tax bracket, they have a 7% interest rate, what do you think their after-tax benefit is? Their interest rate is 5.34%. So that person that you're doing a listing appointment with is, I don't want to give up my 5% interest rate. Well, darling, you're going to get a 5.32% after tax. How about that? So the reality is shifting the paradigm to what is actually the opportunity is what the secret sauce is. Yes, sir. Oh, I'm sorry. I saw this and I said, he must be asking a question. Okay, so the reality is, so how you do this real quick is express a tax bracket, you then multiply the whole 9 yards, and that's how you do it. The reality is this. We have to understand it's not just the beauty of that kitchen or the view from the family room. It's the emotions, the economics of understanding the opportunity. Now listen, timeout warning. Some people are going to come and say, hey, guess what? You told me a 5.32 rate. Yeah, we did. After tax, everybody. So understand that this is kind of not a spin, but it's a reality. Let's talk about mortgage rates. This is the Mortgage Bankers Association forecast, comes out once a month. And it says by the end of 2024, mortgage rates are projected to be 6.4. By the end of 25, 5.9. By the end of 26, 5.5. So that old adage that everybody has what's it called when you overuse something? You overuse it, I guess.
Beat a dead horse.
Beat it. Marry the house, date the rate. Marry the house, date the rate. The consumer has become immune to it. Buy now, refi. So you have to respin it, repackage it into a different area. But here's what I wanted to let you know. It's not if, but it's when. Let me say it one more time. It's not if, but it's when mortgage rates will get under control. Mortgage rates are high. Why? Stubborn inflation. Right? Now, listen, here's the thing. I don't want to practice politics real quick, but you can't keep dumping money into an economy and expect that there's not going to be inflation. You can't keep having massive job growth and assume that there is not going to be massive inflation. But for every 1% mortgage rates move down, 5 million more homeowners are able to afford to buy a house. I'm going to say it one more time because I think it's very, very impactful. When mortgage rates move down 1%, 5 million more people are able to buy a home. Now, this is a benefit for two people, a buyer, but also a seller. The reality is that, let me ask you this question, Bree. Let's assume you've done 12 transactions with sellers last year. What percentage of those sellers are buying another home? 80%. So for a seller, this 5 million more people coming in the market, the opportunity is locked in your housing cost. Oh, I don't want to give up my 3% rate. Well, here's what we should do. Maybe convert that 3% rate home into an investment property, buy this new house. Remember the rule, the IRS rule. I'm not a CPA, nor am I a tax advisor, nor have I spent the night at a Holiday Inn Express recently. That's a good joke, but nobody gets it. I don't know why. Maybe I have to stop that on my thing. Okay. The thing of it is, we have to be empathetic to the fact that people have some epic rates. 80% of the population that has a mortgage has a rate below 5%. So maybe we want to do it in a two-step process. Let's talk about this real quick. Number one, hey, listen, you got an epic mortgage rate. You know what that means? If we convert that to a piece of rental property, guess what? You're going to make massive money. Guess what? The new house we can buy with 5% down. Guess what? We're making a sport utility vehicle decision. In other words, totally portable. Because under the IRS rule today, as long as you live in the house 2 of the last 5 years, you're able to have the primary residence exclusion. So even if somebody converted to a rental property today, moved in the house, new house, converted to rental, and guess what? It doesn't work out. They're not losing the $250,000 or $500,000 worth of gain. Does that make sense to everybody? Okay. Now, I'm going to talk about something very, very controversial. Don't get mad and hit me, okay? I don't want Sir Walter to come bite me or anything, you know? So this is a 10-year minus a 2-year treasury spread. What that means is you can get a higher return on a 2-year than you can on a 10-year. And if you notice, this is, on the bottom, is whenever it's been an inverted yield curve. In the US, there's been 6 times, well actually 7 times, it's been an inverted yield curve. And if you notice, every time this has happened, you'll see this shaded area. That is a recession. Now, regardless of what you see on CNN or Fox News, a recession is part of a natural economic cycle. I believe a recession is coming. Now, is it going to be a deep one like the Great Recession? Probably not. Is it going to be a quick one like we had with the pandemic? The answer is probably not. But there is the highest probability that we will have a recession. And when it does, people are concerned, and this is the elephant in the room that they're asking. A recession doesn't mean, know that a recession doesn't mean falling home prices. It means rising opportunities in housing. A recession is a massive opportunity because all quality assets go up during a recession. Now, it's not me just saying this, it's just basic fact. So, 6 last recessions in the United States of America. America. I call it sandwich, just so you know, too, just in case you're wondering. Obviously, if we take out the Great Recession, which let's just talk about this real quick, because some of you are newer to real estate. Do you understand how we got people approved in 2006 for a mortgage? The heartbeat was not even required. It was, you could state your income, you could state your assets. We didn't care who you kissed in 3rd grade. We didn't even care if you had a job. Now, listen, here's the thing that you're going to be is also very controversial. Those designer mortgage products like CISA, NINA, stated income, stated assets, no income, no assets, they weren't bad products. They were great products sold to the wrong people, which created this environment. At this point, I know when everybody ovulates, I know how they did on their SATs, I know everything in the mortgage process, that what happened in the Great Recession is not going to be rinsed and repeated. But the reality is, if you take this, and let's just say -19, you can take this out of the equation. 4 out of the last 5 recessions, home prices went up. Now listen, I want to say this. There is no quality asset. You guys are familiar with a stock called Apple, right? Are you all familiar with a stock called Microsoft? 2 great companies. Their stock just doesn't go up like this. No quality asset ever goes up in a straight line, to include real estate. There's a point where it retraces a little bit, takes a little nap, recharges, and makes newer highs. That's where we are today, folks.
Kevin, have you ever seen that particular graph I'd be curious if you looked at average rates of home appreciations. Like, have you ever seen that graph overlaid with those dips?
No, but I could.
I'm just
I see
curious.
it.
I'm curious because obviously we had a strong run in appreciation, prior to the Great Recession, and obviously we've had a strong one in COVID. So
Right.
I'm curious how, if that third element was overlaid, what the prediction then would be.
I think we're gonna get to it in a second.
Okay.
Okay, so, but we're gonna see, but I can get a little bit, but what I also wanna share is this. In the last 6 modern recessions in US history, mortgage rates from peak to trough. I was doing this presentation in Florida and somebody goes, what's a trough? From top to bottom, so let me go that way real quick. Mortgage rates dropped 2.35%. Now, by the way, what does that mean? 10 million more people are able to buy. Opportunity, but you have to be a challenger. It's not just about the brick and mortar or a place for people to stay warmer. It is about explaining the opportunity, because as a professional, it's our obligation, duty, and responsibility to communicate that. This also highlights the fact that there will be an opportunity to refinance to a lower rate and also get locked in your home cost. Now, I don't believe if you would say to me, home values are going up 8%, or you would say home values are going up 6%, or you were saying they're going up 4%. I don't believe in one person's opinion. But the home price expectation survey is a sampling of over 100 market movers, experts in the industry of real estate, bond and institutional investors. And they're asked this question, where will home values go over the next 5 years? Now, there are people that are wearing helmets, the bears, and they say 8.1%. The bears are saying home value is still going to keep going up. The people that say the sky is so blue, I need a pair of sunglasses, are saying 33.8%. The panel wide is 20.8%. So what does that mean? A $400,000 house purchased in January of 2024, based solely on appreciation, the home price expectation survey, is going to be worth about north of $480,000. What an opportunity. Now, I personally believe, not for a quote, turn the cameras off, I believe we're closer to this number than this number. But I need you to make sure you understand that the massive millennial and X and Y generations believe, don't compare normal appreciation to the unprecedented rise in appreciation that we experienced during the pandemic. Think normal appreciation like this. We're hopping in the car. By the way, just so you know, I saw Renee several years ago at my favorite place called Washburn's. She didn't know who I was, but we reconnected. I wanted to just tell you, next time you go to Washburn's, you gotta go for breakfast. The most amazing biscuits and gravy, just so you understand. All right, stay with the ball. Let's assume we're going to let's assume we're going to Wilmington. This is what you need to understand. People are visual learners, right? So the reality is this. We're driving to the beach in Wilmington. We're on the highway, the I-40. Listen, there's nobody there. We go ahead, put our foot on the pedal. We're going 95 miles an hour. Wind in our face, and we got Bon Jovi on the radio. But in the distance, guess what we see? What do you think we see? Po-po. What do? We slam on the brakes. And we go 55. Now, we pass the po-po, and maybe we go ahead and we stay at 55 for a little bit. We're still going 55 miles an hour, and that's still pretty damn fast. That's called normal. We right now, appreciation is doing the speed limit. There will be a point when rates start to go down, more demand comes in the market, we're going to start drifting up from 55 to 65 to 75. And that's what you need to explain to people the opportunity. Right now, we're doing the speed limit. We're not going as fast as we were, but we're still going pretty fast, and we're not in the school zone. Now, this is from the Martini Vibe. If you like to get access to it, just click there or take a picture and you go with this frame here. This comes out every Tuesday, and it gives what I like to think is market wisdom, I think some actionable blueprints, and tomorrow's trends. It shares here this. Feel free to copy whatever you get. Whatever's mine is there. Generally speaking, I'll send it out on Tuesday. I won't publish stuff to the general public till Wednesday, so it gives my partners the ability to go ahead and get more access. In the short term, renting may be more cost effective. And that's a fact, everybody. I want to make sure everybody understands that. In the short term, renting is may be more cost effective, but over the long term, homeownership wins. In the United States, in the top 50 metros, based on data, the most recent time was done was February. Now listen, we can have an argument that there's no difference between a studio apartment and a single family house, or no difference between a 3-bedroom, 2-bath in Bedford versus a 2-bedroom condo or apartment in there. I don't want to have that conversation. But so if we take a look at a studio 1-bedroom, the average is $1,708. The average monthly mortgage payment in the U.S. is $1,984. Now, 1984, this number, 1708, the average overall, is $276. So it is $276 more expensive to buy than rent on a monthly basis. Not including the tax benefits, not including the pride of ownership. If you multiply it times 60 bucks, or 60, which is 5 years, renting over 5 years saves you $16,560. Right? Let's assume rents all remain the same, even though we know what happens, rents go up. Now, the home price expectation survey, 83,385 is the potential. A home is going to go up over the next 5 years. So if we take that $83,385 and the cost that you save by renting, home ownership, you can make an extra $66,825, even though rent is $276 less expensive. This is the message to share. Don't let Anderson Cooper or another anchor to talk about the fact that home ownership is less expensive, or renting is less expensive. It's the truth, but not the whole truth. The second thing is we're going to start to see headlines. I don't have this slide here. Foreclosures are up. Foreclosures are still below the 2019 level before the pandemic. Tell Peter that, just so you know, when you see him. So the reality is, does this make sense? Can you see how to weave this into a conversation? Can you see how to go ahead? And by the way, time out real quick. When you're talking to a lead on the telephone, this is going to be very controversial to the very experienced people here. When you're talking to a lead, a prospect, or a suspect on the telephone, there's only one thing you can do. Establish their timing and their motivation. And get their ass in here for an appointment. And when you're belly to belly with them, listen to what their concerns are. But the reality is, write this out. People like math, and they like it done in front of them. Let's talk about mortgages real quick. So, for the longest time, conventional loan was $417,000, $417,000, $424,000. But right now, a conventional loan is $766,550. What does this mean? Huge opportunity. First-time homebuyer could buy a $790,000 house with only 3% down. Do you know that you can now, with this higher home limits, you can, with only 5% down, you can buy a $1.55 million quadplex. Now, listen, I get it. There ain't no quadplexes. But here's the thing. Our goal, timing, motivation on the phone, get the people in and go that route. So these are some of the micro value of higher loan amounts. And these should be like little sound bites or little nuggets that you share with your prospects, suspects, and clients. Just so you know, Johnston and Wake County, an FHA loan, I think when I first moved to Raleigh, an FHA loan was maybe $200,000. It's $529,000. Listen, a quadplex is $1 million. And in Durham and Orange County, you can go an FHA loan up to $600,000. Now, listen, time out real quick. Let me talk about FHA, because there's this perception FHA is only for first-time home buyers. It's not. There's perception that you have to have bad credit to have an FHA loan. You don't. There's a lot of advantages for FHA. Number one is obviously a 3.5% down payment. But it's a little bit different. It's like in England, they don't drive on the wrong side of the road. They drive on a different side of the road. So the FHA has two types of mortgage insurances. I want you to know this. One is an upfront mortgage insurance premium. It's 1.75% of the loan. And one is a life of the loan mortgage insurance premium at 0.55. So listen, the reason I'm sharing this is this. If you have a sales price of $100,000, you're putting 3.5% down, you would think when you're looking at the closing disclosure, it should be $96,500 for the loan amount. The answer, it's not, because there's an upfront mortgage insurance premium, so the loan amount is actually $98,189. Just because you see one of your listings getting an FHA loan, don't discriminate against that person thinking they have bad credit. A lot of benefits. You know that FHA still has a non-qualifying refinance transaction. So in other words, no appraisal, no income, well, they're going to just refinance you. Advantage to them. Number two, guess what? The FHA is still an assumable mortgage. So a lot of advantages for a client that you want to consider. The other thing is the FHA is more flexible on debt to income ratios, and believe it or not, their mortgage insurance is pretty cheap. Remember, with the VA loan, it's not a bad thing. When you get an offer in on one of your lists, oh, this is a VA loan. First off, get your American flag out and help a patriot out. But here's the thing you want to know. With a VA loan, yes, is the appraisal different? Yeah. They're going to look at safety things. So if there's a step down, that railing is loose, guess what? They're going to want you to fix it. But by the way, if you're listing a house that has a loose railing, it should be fixed before. But remember, the VA has something called the funding fee. And the funding fee will depend on whether the soldier's status and things of that nature. Don't forget about the rural development home loan. First off, let's all say what it really is. It's not a USDA loan. It's the rural development loan offered by the United States Department of Agriculture. 100% financing. There's some income limits based on the family. And yes, if the family member lives in, or if one of the kids works at Burger King, their income is included in this number. So let's talk about some things to know. This is again from the Martini Vibe. And this, I don't know, this was probably issue 1, so this was beginning of the year. The 2024 mortgage rates roller coaster. That's just a true statement. So the fact of the matter is, there's one of 3 things that can happen. Somebody can buy now and mortgage rates don't change. Well, at least home values are going up. They can buy now and mortgage rates fall. They can refinance, fair. Or if they buy now and mortgage rates rise, they got a kick-ass deal. The second thing that I want you to know when you're talking to a buyer, a homeowner has a 40x advantage over a renter. Homeowner wealth is 40 times greater than a renter. Not 40%, 40 times greater. Look at this. The average in 2022, when the last time the study was, $10,400 was the net worth of a renter. The average net worth of a homeowner is $396,200. And again, we talk about the old cliche, marry to house, date to rate. Again, our job is not to shock and awe, but it is to shock and awe, to get the appointment, to get the people in here, and go ahead and find out their needs for a buyer consultation. Remember, there's a unique thing. This is a sales pitch on me, just so you know, because I'm probably one of the only still old school lenders. I close all the money with my own loans. I close all my loans with my own money. I process, underwrite, and fund all of my office in downtown Raleigh, but I also offer a floating lock. So what does that mean? So you're working with a buyer right now today. Congratulations. I'll lock their rate today without a property address for up to 60 days. Do a 30-day extension. And then this way they're totally protected. Also, a floating lock is, let's assume your client's under contract and rates die. They're not, but if they do, guess what? We'll float them down once as long as it's within 2 weeks of closing. So that's one of the unique advantages. But I want to talk about rates for a second because there's a huge impact here. 7% and 5%. So how many more people can buy here between this and this? 5 million. Thank you for playing. I appreciate that. $328 is a lot of freaking money to a lot of people. So the reality is this. How do we capitalize on this? Now, in case you're new to the planet Earth, you have not heard of something called a temporary seller paid buy down. But if you live in a van down by the river, I want to just make sure you know this real quick. There's 3 common buy downs. A 1-0, a 2-1, and a 3-2-1. And now Sharon is pushing and advocating, we're working on getting what's called a 1-1 buy down. More on that later. But in case you don't know what a buy down is, seller pays a fee to reduce the interest rate by 1% for the first year. That's simple. So if the rate's 7%, they get a rate of 6%. So in this example, this guy's buying a $500,000 or gal's buying a $500,000 house. Instead of paying this, they're going to pay this. They're going to save $328. Here's the thing that is missed by everybody. Think concession, not price reduction. Think concession, not price reduction. Because it's not if, but when somebody's going to refi. But this is what nobody talks about on the buy down, in my opinion, is a quasi-asset. So on a $500,000 mortgage, a 1-0 buy down will cost $5,000. So Renee buys the house on Monday. Guess what? Rates dive on Tuesday to whatever. She has her $500,000 mortgage. When I'm refinancing her mortgage, she's only refinancing $495,000 because the remaining balance of the buy down is credited to reduce the principal balance. It's malpractice not to consider this. I'm not going to say every seller's going to say yes, but not every seller's going to say no. Right now, we do 60 transactions a month between my son and I. And right now, we are about 70% of our transactions go with a buy down. Now, defining seller concessions. Listen, I don't want to really talk about this, but I'm going to talk about it real quick. Listen, we're going to go through, you guys in the real estate community are going to go through what I and the mortgage industry went through after the mortgage renaissance. Dodd-Frank just made things different, not bad. this new legislation is going to make things different, not bad. The great news in North Carolina, buyer agency isn't a new toy on the shelf. It's something that we should be deploying. We're one of only, I think it's 13 states that have it. But remember that the seller can still pay the buyer agent's commission and it not be part of interested party concessions. So if Renee is buying putting 20% down and Sharon's the seller, she can still give them 6% of closing costs and can still do the buyer agent fee. So the reality is, I don't want to talk about this because it's going to get diluted, but the reality is, let me just say something. What's happening in this industry, whether we agree or disagree, it's amazing. Because part-time is out, profession is in. You're now going to be either NFL or you're going to be flag football. There's going to be no distinction. And also, let me say this to you, high probability the biggest winners are going to be teams. Because an independent sole proprietor agent will not have the bandwidth to provide the value and the education to actually do that. But anyway, all right, keep it on the top of mortgages. By the way, it's a crazy idea. Well, it's not an idea, it's a fact. 40% of single family homes will be owned by institutional investors like BlackRock and Jimmy Dimon. Single family rental properties by 2030. Is that not amazing?
That's scary.
Rental properties, all right. So there's something called a non-qualified mortgage that offers something called a DSCR, which stands for debt service coverage ratio. And I'm going to go ahead and explain this at the quickest level real quick. You want to buy a rental property? Yeah. He has 20%. Need 20%. Guess what? The rent is $1,000 a month. How do I know what the rent is? Because we asked the appraiser to do something called the comparable rent schedule. If your mortgage payment is $1,000, approved. If the mortgage payment is $1,100, denied. You need more money to put down. Okay? 1 out of 5 Americans are self-employed. Oh, I'm self-employed, I can't buy a house. Bullshit. Excuse me. Being your own boss doesn't mean that you can't buy a house. It means that we might have to look at tax returns or restructure how you do tax returns. Maybe we can do a bank statement loan. Maybe we can go ahead and do a 1099 loan. There are options. Don't discriminate just because somebody says they're self-employed. Buy first, sell second. The modern bridge. A lot of controversy on this because this is a new product. And let me make sure everybody understands this real quick. I do this product as a courtesy and make no money off of it. Just like a referral. If I say, hey, listen, you got to call this inspector or things of that nature. I do this just as a referral because they're the best in the business that does that. There's a lot of people that claim that they do this, but they don't actually deliver at the closing table. It's called the modern bridge. First off, it's your client, your deal, and none of the risk. Number 2, it helps your clients avoid a double move. Number 3, it helps your client maximize the sales price of the current home. So let's look at this at a very high level. The value of the house the client is selling is $100,000. They have a $25,000 mortgage. You know what we need in this office here? A whiteboard, Sharon Evans. I just want to throw it out there real quick.
One of those like smart ones too.
Well, you could do that, but there's 7,000. I'm just saying a whiteboard you buy at Office Depot. I mean, this girl can shop, just so you know. I will let you know that. All right. So the mortgage is $25,000. The home value is $100,000. The modern bridge allows the person to unleash 75% of the value of the house. So for those home gamers that are not good at math, that's $75,000. See that 75,000? We're going to subtract the mortgage, which is 25. That means they can get $50,000. What happens is they get, the benefit is that we close on their new house, they can use that $50,000 towards the down payment, closing costs, repairs, whatever it is, but they get the money because we do a simultaneous close. In other words, we close at 9 o'clock on the modern bridge, 10 o'clock they close on their new home. The bridge loan has no interest cost, has no monthly payments. The bridge loan requires that A, the house is listed within 21 days of closing, and the bridge loan wants the house sold in 90 days. Now, there's no such thing as a free lunch. They're going to charge about $1,500 for an admin fee and a home inspection, and they're going to charge 2.4% with a minimum of $9,000 at the sale of the house. So when that house sells for $100,000, they're going to take $9,000 because it's under the minimum requirement. Now, here's the one thing. I think that this is about, Sharon, what do you think is about 30% less expensive than that ribbon and stuff?
Oh, it's at least 50 to 75. So I would say when we look at products like Acre, where they'll buy the house and you can rent it for a while and decide if you want to buy, or we look at Ribbon, who will buy and then give you 6 more months to sell, or we look at the product like someone just says, walks in new construction or loves a house that they just magically saw listed and weren't thinking of buying, or they pull the ripcord and just want open door to buy it. I think we see over and over again 5-6% minimum total costs, but easily can be 10% plus, depending on which door they choose. There was a new one that was supposed to come to this market Q2 called Homeward, that's in Atlanta, and the only reason I heard about it is because Mark Spain's will give you an offer thing. The only group that they do it with, because they picked it up in Atlanta, is here in the Raleigh market. They do it for.
And they go up to 85.
So yeah, so they would go up to 85% of what the agent said it was worth, and then let the agent sell it. But even in that, it was a minimum of a 5% transactional cost.
So,
but it was just ways of like not having to just go the open door if you're going to lose your ass. You know, plus us as agents can still pick up the business, right?
now this is hedge fund money. I'm going to tell you everybody this is hedge fund money that does this real quick.
Right.
So let me just tell you this. They don't have lipstick, and I don't even think they wear cologne, right? So the reality is that they're hedge funds. They're just doing transactions to go through the role. The client experience is very, very bumpy with them. It is what it is. But the reality is something that we do and we have access to. Is this right for everybody? The answer is no. But I will tell you that we have 12 transactions with this right now, and 11 of those 12 transactions would have never consummated the purchase.
Correct.
Or the buy first, sell second, unless this is done. Now, I'm going to also say this, and everybody's going to laugh. Do you think, well, it's your association, the National Association of Realtors. Do you know the National Association of Realtors says that a home that is properly staged will most likely sell for 2 to 3% more?
Easy.
Is that fair statement?
Oh, yeah.
So when you think about it, this program is free. I hate to use it that way. Does it make sense? Because you're getting more money because you're properly staging the house and things of that nature. Now listen, this is a program that I want to just give a 30,000 feet soundbite of it. We can hover over on top of it on a personal basis. We have no problem to do that real quick, but it's something to consider. The next elephant, approximately 80% of the homeowners with a mortgage benefit from an interest rate under 50%. And nearly 25% of them have a rate under 3%. Empathy. So we're going to do a little role play. You have a 3% interest rate. I'm not a realtor, just so you know. So I'm just going to play this by ear, see how I do. Renee, I want you to list your house with me. Why don't you want to do it, damn it?
Because I have an interest rate of 2.65%.
Wow, that is amazing. Can I ask you this? How long? I know you have an amazing rate, but let's forget about the rate for a hot second. Does your home fit your needs for today, next week, next month, next year?
I'm assuming you want me to answer that, no.
No, you can ask whatever it would be.
I mean, yes.
It does.
Yes.
Your home fits all the needs real quick.
Yes.
So if you were to move, where would it be?
Land in Pittsburgh.
Who the hell wants to move to Pittsburgh? Anyway, stay with the ball for a second. All right. So,
Well, you're asking me what we're going to
so let me ask you this question. If land in Pittsburgh was where you want to move, and you got an epic rate at 2.625%, if there was a way that you could have your cake and eat it too, would that be of interest to you?
Of course.
Fantastic. Do you know that there's a way that a lot of my clients buy and retain, because that's going to give me a transaction down the road, because you'll never be a landlord. But anyway, just stay with the ball. Buy and retain, which gives us the opportunity to go ahead and let you buy your new dream home today. Why real estate is on sale, not just for sale. You keep that epic rate you have at 2.625, and guess what? We convert that to a piece of rental property, and you're going to be most likely positive cash flow to offset that dream home in Pittsburgh, and you can do it now. Now, thanks for playing. I'm not saying that my scripting is 100% correct, but all that you want to do is change your Tinder profile to add some more hair and let me lose 30 pounds of weight. And let's see what the discussion is. If you notice the one thing, where would you go? There was one thing she said. We have not talked about this in advance enough. Pittsburgh with land. She said that, right? Right. So look, she also says herself how she wants to expand. So remember, 2 ears, one mouth. Listen. Start to talk about the benefit of that. By the way, time out. I used to practice real estate. 2005 was my last year. I did about 10 million, did it part-time. And I worked for a company called Kai. Still work with them now, not as a realtor, but as their lender. But anyway, stay with the ball. And they had a unique program where when you were a new agent, you had them have a mentor for your first 3 transactions. By the way, do you do it like this or do you do it like this? All my coaches say I do it wrong. This is how you're supposed to do it, not this. Anyway, you had to have this mentor. And I remember this mentor, we had this client. I remember this client talking to me about how she loved oranges and wanted to have a house with an orange tree. So we walked into this house, and guess what? At the front door, guess what there was? An orange tree. But by the way, your job was just to shadow. You couldn't say anything. So you walked into the living room, and there was a family room, and there was a big glass window, pool, all orange trees. Walked over this way real quick, kitchen, a door out to the pool. Guess what there was? Orange trees. Do you know that that realtor did not mention orange trees once? Do you know that, you think about that for a second. Just think, you walk home, you can walk in your door, Mr. and Mrs. Buyer, you can smell the oranges. There's no emotion instead of everybody just pedaling. Or from your bed, from your kitchen, you can walk out and make fresh squeezed orange juice every morning. Listen to what the client says. Everybody watches HGTV. Everybody wants that dream. Anyway, does that make sense? So buy and retain. The reason that I say a now transaction with a buy and much more transactions down the road, because 2 things are going to happen. She's going to go for it, hooking them out. She's going to hate renting. Okay, you hate renting, no problem. Remember this, we're making a portable decision because under the IRS code, as long as we sell within 2 of the next 5 years, that gain from that house is gonna be tax-free. Number 2, you love it? More transactions, because once they get hooked on being a renter, they're gonna buy more properties and more properties. And guess who's gonna be the agent? You are.
She doesn't want to do that.
So, finally, in the Martini Vibe, there's access to Masters of the Future of Real Estate Marketing, a new book that I wrote. If you guys get the Martini Vibe, just go ahead and do it. It's totally free, and it's something that I think that a lot of people are doing. We do, right now, let me just tell you this. AI is not going to replace you. Let me say it again. But AI is going to replace the agent who's not doing it with the agent that is using it. So go ahead and take a sneak peek at this. So I'm Kevin Martini. Was this fun? Say yes.
Yes.
Was this educational? Say yes.
Yes.
I'm married, ladies, just so everybody knows that real quick. But what questions do you have for me? Wow, did a great job, huh?
How do rates on DSCR loans compared to normal?
They're expensive as hell.
Yeah.
Okay. So I'm doing a DSCR right now for a guy in Wilmington. By the way, his son is going to summer school in Wilmington. So he the rate was 8.5.
I mean,
So-
that's not so bad.
That's
I mean,
not
it's
bad
not
without a
horrible.
rate.
I mean, it's not great. But it's-
Well, I mean, but it's a no document loan, the whole 9 yards.
It's pretty competitive with hard money then at that point.
It is.
Mhm.
So hard money will be more than that.
So, so the difference is this, I do not broker my DSCR products real quick. So I'm strict at my 1-1 because I hold the paper. So the reality is I'm very strict with my hedge and the whole 9 yards is at 1. There are other people that allow a DSCR less than 1. I'm just not that guy, just so you understand that real quick.
But you have to have a primary residence to get a DSCR loan, right?
Yes. Like, the answer is not necessarily. Like, I have a client in New York who rents in New York, and he's buying a DSCR, and you play golf there, Hilton Head, right? So he's doing an investment property
You
there.
just can't live there.
You just can't live there.
Mm.
It's just you have to go into what they call a recreational area or a tourist area. If you don't do that, you have to live in a market that's more customary to rent. Yes, you can do it real quick.
Mm.
But the reality, so let me backtrack here real quick. And I don't want to show hands. But I want to make a statement first. 1.5 million is what is believed is needed to go ahead and retire. Now listen, at 1.5 million, you're not rich. At a 4% return, that's $53,000 a year. I believe that the way to create generational wealth is through real estate. And I'm going to share that because I believe it in my heart, and I put my money in my mouth where I'm not bragging, I'm telling you I got $6 million in real rental properties, plus commercial properties. The thing that I'm sharing with you is with the DSCR, oh, I don't have good tax returns, Kevin. We don't look at them. Listen, I have a client that bought a $115,000 rental property in Fayetteville. I have a client that has bought in the Wilmington market 22 since 21, 22 rental properties using the DSCR program. So you guys, as real estate people, if you don't own a home, I get it, the whole 9 yards, get a house, get an FHA, get a cosigner, but I'm gonna tell you this, if you own a home, buy some rental properties. Be part of, Wall Street is betting on it, right? Is real estate, I don't know about you, but they aren't making any less of it. So, but the DSCR is an amazing path, zero path to get that done.
Do they need to be turnkey?
Qualify? Yeah, it's not like you can do it. It's not like what you're doing. You gotta be able to bring a toothbrush and move in.
Okay.
So you can't do what you do on Instagram. Make sense? You know what I'm
Yeah.
saying? I don't want to see you working at 3 in the morning trying to fix things. No, the answer is yes.
Okay.
It's a bring your toothbrush scenario.
Makes sense.
But guys, listen, I'm going to tell you this also. I think it's never been easier to partner with the wrong lender than it is right now. And I'd love to have the opportunity if I can be any help. I'm Kevin Martini, and I'm here. I think we do things a little bit different. Don't want to make it a sales pitch because I want to make this educational. Any other questions? Did I miss anything?
I have a question.
Yes, ma'am.
That 5% down FHA multifamily,
FHA's 3.5. Conventional is 5%.
well, but it was for multifamily.
So
So
FHA,
3.5?
yeah.
But don't you have to live in one of the units?
You do. You gotta live in one of those units, correct? But I mean, that's a bad change. Do you know that last year, before October, I don't remember what it was, but last year, okay, you couldn't buy a duplex, triplex, quadplex without 25% down. 5%. Oh, added bonus, ding, 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 ding. We used the projected rent on the other vacant units to qualify you. Huge.
What, they have to live in it 1 year?
1 year. So there's a book that I've been asked to write and working on it right now. The title is Buy Your First House in 90 Days and Your First Investment in 361 Days. And how the gimmick is, not the gimmick, I don't know if the word's gimmick, is the word gimmick? The hook. You only gotta live in a house you get a USDA house with 100% financing, guess what? Only gotta live in it 1 year. Next house, 5% down. Maybe it's gonna be a duplex, maybe it's not. But you 5% down. And keep rinsing and repeating. Rinse and repeat, rinse and repeat, rinse and repeat. It's huge. There is right now, you are doing a disservice to all your friends, your family, and anybody who's in your database unless you pick up the phone and call them and explain that. And it's because if you don't do it, some very savvy marketers are going to start to do it. Because once this once this new thing goes, you're going to find more savvy marketers are going to get into the real estate business that don't deserve to be in the real estate business. So the market share that you gain today by giving a servant's heart to educate them is huge. For example, that client that's buying in Wilmington for his son, I knew in his database his son was graduating college graduating high school in the fall. That's how long I've been working on it. Say, by the way, why do you want to live in a dorm? Buy a house, let's rent it, the whole 9 yards. Some people might be there's a client going to UNCW not US, the one in Greensboro, UNCG. They're buying a triplex. Son's living in one, renting the other 3. The parent is a non-occupant co-borrower. Happen. Use a mortgage as a tool to help buyers become homeowners. Sharon, thank you for having me. I appreciate you.
For being here.
And by the way, doesn't Sharon look like full like spring? You look full like spring.
I'm great.
I did that. Awesome. Anything else? Any other questions? Come on, nothing?
You did a great job.
Jumbo's
Yeah.
what, 750?
North is 776, 550, guys.
Okay.
But Jumbo, you can do 10% down, a little 10.01% down. There's some great deals at Jumbo with 15% down and the whole 9 yards.
And then rates are about how much higher?
A little bit. Some depends on the individual client.
I'm
Could
just
be better,
curious.
could be worse.
Yeah, I was gonna say, because I know it seemed like during a time period, jumbo was actually more preferable to
Yeah.
conventional, but I was
Yeah.
curious if that's still kind of.
I think that right now it depends on the end investor because jumbos don't necessarily trade on the open market. So sometimes Chase has to build a portfolio and to give me an edge. Sometimes Citibank or Truist or the whole 9 yards. But listen, bring a gun to your pillow fight. That is the secret of success. Bring the gun to your pillow fight. And knowing this knowledge is the way to go. Because I'm going to tell you this. Real estate is getting ready to explode.
I also think it's interesting because I didn't know it till probably about 2-3 years ago, and you do a lot of VA.
Yeah.
and someone just tried it on a $2 million house. So VA buyers can be zeroed down with a funding fee. I get that. But they also, if they go over the 776, is that the jumbo line for them too?
The VA technically has no loan limits. If you qualify, you could do a $10 million loan.
Okay, because for a while there, it was like go up to the line, and then after the line, they had to bring 25%. But that was still less than 20% of the whole thing when they were trying to avoid jumbo on the conventional. So I saw people doing that. So there's none of that anymore. It's just straight up. You just qualify.
So I think we did a loan. Sharon and I. You know that weird guy that was a professor.
Weird.
He died in Hawaii, and then he became alive. You know what I'm talking about?
Oh.
Yeah. Anyway.
That's okay.
So I'm going to just share this real quick. Do you want to know what this guy's debt to income ratio is? If you know income to debt, and his house I think was $800,000, $900,000. What do you think it was?
Income to debt or debt to?
Yeah, debt to income was 94%. And we got him approved.
How's that
I'm a direct lender with the Department of Veteran Affairs, so I can make an argument of common sense to them. The guy had $2 million in the bank. So the reality is this. Number two, so that was 100% fine. You don't know what I'm talking about?
I'll have to.
I'll tell you afterwards because
Yes.
you'll know. They had a baby. He died. Anyway, he died, but then he became alive and quit everything.
Okay.
Okay.
Oh yeah, thanks, people.
Oh, yes. I mean, I thought that was pretty obvious what
No.
that.
I was like, he didn't.
So a lot of people that
Y'all, he didn't die.
Yeah.
I get it. Like he had to be resuscitated. I thought you meant like
What
someone
would
faked their death. He
Oh,
was
that's
gone,
it.
and then finally somehow appeared in
I
Hawaii.
thought on that one,
Yeah.
like they got resuscitated.
Okay, sorry. Now I know who we're talking about.
All right. So the reality, and so and I think what you're talking about real quick is about 25%. There is a myth you can only have one VA loan at a time, and there's something called bonus entitlement, which allows it might be 25%, it might be 3% or 4%. There's a mathematical equation on how much additional mortgages you can have without putting a down payment, but you could do that as well. So the thing of it is, I don't want anybody here, listen, I don't have anything about setbacks or easements or how a well or a septic system works. I don't know anything about what a good square footage is. It's not my wheelhouse. Nor am I asking you to become experts in the mortgage arena. I'm just asking you to understand the sound bites that are out there and know that I'm here to help.
But I think we need to know just these basics, because then you kind of run into somebody and say, oh, there might be a product for you. Let's get you over. And somebody has never heard of this or that before. You go, I think there's something. Let's get creative. Let's find out if something's for you.
Right.
And that's the point. I think a lot of other people just think, oh, nope. Okay, you're not a buyer.
Yeah. So I had a client last night. No, not last week. I don't remember what day it was. And they were going through a bankruptcy. And my partner said they still want stock, or they finished the bankruptcy. My client, my realtor knew, not even a note from my mom would help them get a loan. And it's 100% true. We're in a relationship business. We had the conversation. Here, I'm sorry, bad things happen to good people. And I am pretty much confident that that person, when they're able to buy in 2 years, will use me, will use that agent, because we will stay in touch with them. And we gave them grace in a very difficult period of time. And most likely that person will be a strong advocate for referring business to me as well. So what you think you know, get rid of this idea that I only want to talk to you if you want to buy right now. Only want to talk to you if you want to buy right now. Only want to talk to you if you want to buy right now. This is those other people that moved from Florida to the neighborhood you're in.
Yep,
Okay.
Murphy's,
So how long were they in Florida?
9 months.
They were 9 months. But she still stayed in touch. They moved out of the market. And they bought a what? $2 million house.
Because I hated Florida.
It's not, the worst part that you can make a mistake is You don't have past clients. You only have clients. And remember this, I don't care what's on your business card. And I'll say this and I don't care what's on your business card. Real estate advisor, realtor, real estate professional. At the end of the day, we're all salespeople. And the product we sell is real estate. Period. So stay in touch with that database.
And I just have to say, you really need somebody. I've really enjoyed the last couple of years being very in tune with Kevin because he connects with the clients, gives them information. I just had people this weekend that she's a doctor. They've got some $3 million house in Preston and on the golf course with, you know, pools and putting greens and all kinds of stuff they could tell me about. But they said to me after talking to him, because they said, well, we obviously need to sell to buy this house you're showing us. I'm like, well, that's not obvious, and this house is gonna have offers most likely, so let's talk about, is it equity line, do you just qualify now for both, what can we do, would you talk to Kevin? Yeah, I'll talk to Kevin. And then when I saw him the next day at a second showing, they're like, this guy sounds like he really knows his stuff, and he's been around a while, like, we've been here a long time, we've not heard of him. And I'm thinking, well, you didn't hear of me, and I've been here a long time too. We're both really good at what we do. But what it really was they were very impressed. They were very impressed with the information, how education, like you just didn't assume, well, they've got a $3 million house, they're looking at buying a different house, and like just assume they knew numbers and knew their shit. Like you really broke it down for them and educated on things they hadn't thought about. And they were very impressed. So I'm just saying, no matter what, as a realtor, you need that in your arsenal. Not just someone who can run numbers and hope it's the lowest, or not that they can just push a button on Rocket Mortgage, but someone who forms this relationship and impresses people, that they have a lot of different ways of getting to an end line that makes a lot of sense for them.
Well, but I think one of the things that Sharon and I are very in tune and very much alike. We do not care about the outcome. Is that a fair statement?
Yeah,
When we
I mean,
talk to the client.
here, but yes, but I'm not pressing for the outcome.
It's not our driving force. It's not our guiding post, our North Star. It is. Let's give them the information to make an educated decision, because people just want to do that. I mean, people just want to have the knowledge that they don't do. And just because you there's a chap that sells Range Rovers, helped them. I was in the office last week, and sells Range Rovers. So you expect he kind of understands credit and all that kind of shit. No, knew nothing. Again, assume nothing, and say, hey, listen, I want to meet you where you are. So if I ever say something you already know, just say, hey, Kevin, fast forward. But remember, lead with a servant's heart, not commission breath, and the commission will come. Thank you so much, everybody. I appreciate you. Now let's go sell some houses.
Amen.